Welcome to this presentation on option Vega, which is measurement of options price sensitivity to changes in the volatility of the underlying asset. Now, what is the mathematical calculation of option Vega? These are the areas we'll be covering in this presentation. How is Vega used to predict the change in option price for change in underlying volatility? How does the Vega vary for call and put options with change in the strike price? How does Vega change with change in time to expiry? How is Vega used in real-world option trade? How is Vega useful in hedging? I am Aninda Datta, the presenter. My email contact point is also mentioned here. Now let's examine option Vega mathematically. It is the first order partial derivative of Black-Scholes option price with respect to change in the implied volatility. The formula for Vega is given in the picture. The formula for PDF function of D1 is also given. T is time to expiry, ND1 is the probability distribution, N-D1 is the probability distribution function of T1, and S is the spot price of the underlying. The formula for option Vega arrived at by differentiating Black-Scholes option pricing formula with implied volatility is mentioned in the box. The Vega formula is same for both call and put options. The formula gives the change in option price for 100% change in implied volatility, as 1% represents 100% volatility in Black-Scholes formula. So the formula needs to be divided by 100 to arrive at change in option price for 1% change in volatility. The Vega formula gives the change in option price in absolute value and not percentage. The implied volatility of an option cannot be verified from the marketplace, but is determined by back calculating from the option price from the evident parameters like S, spot price, time to expiry, risk-free rate. So a change in option price is attributable to Vega only if the underlying price and time to expiry are constant. Now let's see how the option price and Vega vary with the changes in the implied volatility. Now let's examine the BSNM call price and Vega of the at-the-money call option at various levels of implied volatility. The table and graph show the plotting of ATM call value and the corresponding Vega. As the CE value, the green curve represented by the green curve plotted against the implied volatility visually looks a straight line. So the slope of the line is almost same, but not exactly the same. As Vega is slope of this line represented by the yellow, so Vega is a very straightish curve. Looks straight visually, but not exactly straight. Now the second table shows the P price and the Vega of an in-money put option plotted against the implied volatility. Here the in-money put price and Vega have been plotted against implied volatility. The put price is shown by the green colored curve and the Vega is shown by the yellow colored curve. The tangent drawn towards the P price curve by the black line represents the Vega at that point. How to use Vega to predict the change in option price with change in implied volatility. The first table shows the parameter values of a call option to be used for Vega calculation. The second table shows the option price and the Vega of the call option. As BSM formula gives the call price as rupees 13.75 and the Vega at 38.32. Now if we increase the implied volatility by 100% to 130%, keeping all other parameters same, then the new option price should be 52.07. However, on recalculating the option price as per BSM, the price comes as 50. Since the Vega curve plotted against volatility is not straight, so the precise prediction is not possible. As seen from the graph, the Vega curve is downward sloping, so actual recalculated call option price is lower than the predicted one. Now let's examine at what strike price to spot price relationship the Vega is highest. Vega is highest when spot price is equal to the strike price for both call and put options. Now in the first two graphs, both call and put options have strike price of $100. As could be seen in both call and put options, the Vega is highest where spot price is equal to the strike price, that is around 100. Now let's plot the Vega against the underlying spot price after changing the strike price to 70. As could be seen, the highest point of Vega shifts to 70 on the x-axis. As Vega works on the extrinsic value, so intuitively Vega should be highest where extrinsic value is highest. Now let's examine how Vega varies with time to expiry. Vega increases with increase in time to expiry if spot price and implied volatility remain constant. As depicted in both the graphs, Vega curves for call and put options across time to expiry are increasing. So in both the graphs which cover at the money, in the money and out of money call and put options, the Vega curves are upward sloping. As depicted in both the graphs, the Vega increases with increase in time to expiry when other parameters are constant. However, the extent of upward slope varies across the curves. Now let's see what is Vega risk and how to manage the same. Long option is long Vega as the option price goes up on increase in volatility, so position becomes more profitable. Similarly, short option is short Vega as position becomes more profitable on fall in volatility and consequent fall in Vega. In a combined position, say debit call spread, the net Vega position is arrived at by doing linear combination of Vegas of individual positions, but the net Vega is less than that of the naked options. The table shows price and Vega position of a debit call spread portfolio, having long call at a strike of 70 and the short call at strike of 90. Here the debit call spread position is a Vega of minus 7.25. So the position is net Vega short. That is, if underlying implied volatility reduces, the position's profitability increases. This table has been calculated at an implied volatility of 30%. Now let's calculate option prices using reduced implied volatility of 20% in this new table. The reduced implied volatility increases the profitability of the position from 9.55 to 10.41. As the position was short Vega, so profitability increases with a decline in volatility. Now let's examine the need for managing option Vega and strategies for doing the same. Managing Vega exposure is crucial for option-based portfolio managers to control the overall risk of their positions. This is more so in the long-dated options and for assets having high realized volatility, as those have higher extrinsic value and Vega. Managing Vega is important for options-based portfolios to control overall risk to their portfolios. Now, what are the strategies for managing option Vega? Vega hedging is trading offsetting positions to reduce the overall Vega exposure of a portfolio. A Vega diversification. Combining options with different Vega profiles to balance out the volatility sensitivity of a portfolio. Vega targeting. Actively selecting options based on their Vega characteristics to align with a trader's volatility outlook. So this concludes this presentation on Vega, option Vega. So thanks for watching.